Hey, it's Easy Parrot, BS analyst right here on Crypto Parrot. I break down the charts, decode the news, and help you ride the waves. Smash that like, hit subscribe, and let's fly through this market together. It's April 8th, 2025, and the crypto market just took a major punch to the gut. Let's talk about what really caused this pullback, because it wasn't just technicals. Today, the Trump administration officially imposed a 104% tariff on Chinese imports, effective midnight. The news rocked global markets, and crypto wasn't spared. Bitcoin, which had been gearing up for what looked like a textbook recovery rally, got slammed. BTC ran as high as $80,148 this morning, and then just dumped straight down to 76,451. As of now, it's trading around 76,640, down 2.5% on the day. And here's the thing, this pullback isn't just noise. It's a macro reaction to growing fears of a renewed trade war between the world's two largest economies. Until we get clarity on how deep this tariff go and what China's response will be, that recovery rally, it's on pause. Markets hate uncertainty. And right now, we've got a mountain of it. But it's not all bad news. In a massive regulatory shift, the US Department of Justice just disbanded its National Cryptocurrency Enforcement Team. That's right, the NCET is no more. The DOJ is pivoting. No longer will they go after platforms or crypto tech itself. They're focusing solely on actual criminals using crypto to commit crimes. This is a clear green light for innovation in the US, and one of the most pro-crypto moves we've seen from this administration. Meanwhile, in Europe, regulators are getting nervous. The European Securities and Markets Authority issued a warning today, saying crypto could pose risk to financial stability. That kind of language tells you one thing: crypto is becoming too big to ignore. Let's move over to the institutional side, because Ripple just made a $1 billion power play. The company behind XRP is acquiring prime brokerage firm Hidden Road for $1.25 billion. This is about way more than headlines. It's Ripple planting its flag deep into institutional DeFi. XRP is holding up well despite the market dip, currently trading around $1.83. And check this, Dogecoin is back in motion. The meme coin rallied 10%, hitting around 0.243. Whether it's just short-term hype or a signal of returning retail interest, is back on the radar. Also worth noting, analysts at Grayscale say Bitcoin's behavior, even with this tariff-driven pullback, shows resilience. With the US dollar weakening and stagflation risks on the rise, BTC is still being eyed as a long-term hedge against the chaos unfolding in traditional markets. That's your crypto rundown for April 8th. The bottom line, macro is in control right now. Tariffs, trade wars, and uncertainty are dragging on momentum. But behind the scenes, institutions are building, regulators are pivoting, and the long-term foundations of this industry have never been stronger. Now, while everyone's eyes are on tariffs and price charts, there's something even bigger brewing beneath the surface, and it's being completely overlooked. Let's talk about why I believe quantitative easing has already started. Quietly, is the world secretly entering a new era of QE without the Federal Reserve doing anything? While everyone's focused on interest rates and central bank speeches, something big is happening under the surface, and it's about to shake the global economy and crypto markets. You've heard of QE and QT. You've heard about interest rates. But what if I told you that the effects of quantitative easing are already playing out right now? And the craziest part, it's happening because of stablecoins, the US debt ceiling, and basic supply and demand economics. Let's break this down. QT, or quantitative tightening, is when the Federal Reserve slows down or stops buying US bonds. That's bearish because it reduces demand, lowers bond prices, and pushes yields higher. QE, or quantitative easing, is the opposite. The Fed increases its bond purchases. That's bullish. It raises demand, drives bond prices higher, and pushes yields lower. And here's the key. Bond yields directly influence interest rates, which affect everything from your mortgage and car loan to crypto valuations and stock market trends. When bond prices go up, yields go down. And when yields go down, borrowing gets cheaper, risk assets rally, and liquidity floods the market. So, what happens when the Fed isn't doing QE, but bond prices are still going up and yields are still falling? That's the interesting part. As of January 2025, the US hit its debt ceiling. That means the Treasury legally cannot issue new bonds. No new supply. And in any market, when supply drops while demand stays the same or increases, prices rise. In this case, bond prices are rising, which means yields are falling. So we're getting the same effect as QE, just from a different mechanism. Here's where it gets even more interesting. Enter stablecoins. Tether alone holds over $97 billion in US treasuries. Yes, the same stablecoin used across crypto exchanges is buying massive amounts of short-term US government debt. Why? Because they need liquid, low-risk, yield-generating assets to back their tokens. So instead of the Fed buying bonds, stablecoin issuers are doing it at scale. They are buying short-term treasury bills, massively increasing demand. And what happens when demand for short-term bonds goes up? Prices rise, yields fall. Now, you might say, sure, but that's only short-term yields. What about long-term yields like the all-important 10-year? Here's the trick. When short-term yields fall, say from 3% to 2%, investors start asking themselves, why settle for 2% when I can get 4% on a 10th-year bond? That's when capital rotates into longer duration bonds. More demand for 10-year treasuries pushes their prices up and yields down. This is exactly how traditional QE works. The Fed lowers short-term interest rates. That starts a cascade where investors move out the yield curve looking for better returns, dragging down long-term yields too. So even though stablecoin issuers are only buying short-term bonds, the effect spills over into the entire yield curve. That's why we're seeing longer-term yields falling right now, without the Fed having to buy a single long bond. It's functional QE without the Fed, and this has massive implications. Lower yields mean cheaper borrowing, more liquidity, more appetite for risk, more capital flowing into stocks, real estate, and of course, crypto. If you're a trader, a builder, or just someone trying to understand what's driving markets, this matters. Because right now, the market thinks QT is still happening, but the supply side has been cut off by the debt ceiling, and the demand side has been taken over by stable coins. Together, that mimics QE almost perfectly. And in a world where yields fall and liquidity rises, it's only a matter of time before markets catch on. So when people ask, is the Fed going to start QE again? Tell them it already has, just not in the way they expect. The era of financial centralization is being challenged by new players. Tether, Circle, stablecoin giants that aren't waiting for the Fed. They're stepping in, buying bonds, and moving markets. This isn't the future. It's happening now. Pay attention to the debt ceiling. Watch stablecoin reserves. Follow bond yields. Because behind the noise, the new QE is already here. That's it for today, everyone. If you learned something, give this video a like, hit subscribe, and turn on the bell so you don't miss the next update. I'm Easy Parrot. Stay smart, stay curious, and I'll see you in the next one.